Most traders think the secret to success is finding better entries. They're convinced that one more indicator, one more pattern, or one more strategy will finally unlock consistency. But what if the thing holding you back isn't your entry at all? What if the biggest difference between struggling traders and successful traders comes from a decision that's made before a trade is ever placed? Watch traders long enough and you'll notice something interesting. Most losses don't happen because the market was unpredictable. They happen because risk was ignored. A trader sees an opportunity, feels confident, increases position size, and suddenly one trade matters too much. Sound familiar? The market doesn't have to move very far to create damage when too much is at stake. And that's where the 1% rule enters the picture. The rule is simple. On any single trade, you risk no more than 1% of your trading capital. Not 5%, not 10%, just 1%. At first, that sounds almost disappointing. How could something so small change everything? Because trading is not a game of making money. Trading is a game of staying in the game long enough for your edge to work. Think about it. What happens when you lose 10% on a single trade? The next trade feels heavier. Emotions become louder. Decisions become less objective. Now imagine losing only 1%. The loss still matters, but it doesn't control you. And that's the real advantage. The 1% rule protects more than your account. It protects your judgment. Have you ever noticed how disciplined traders seem calm even during losing streaks? It's not because they enjoy losses. It's because no single loss has the power to threaten them. When risk stays small, fear stays manageable. When fear stays manageable, decisions improve. Better decisions lead to better execution. Better execution allows a real edge to emerge. Cause and effect. Most traders try to improve results by changing strategies. Few realize they could improve results by changing exposure. That's an important distinction. The market rewards consistency, not intensity. So how do you apply this? Before entering a trade, identify where the trade idea becomes invalid. That's your stop level. Then calculate position size so that if the stop is hit, the loss equals no more than 1% of your account. Notice the sequence. Risk comes first. Position size comes second. The trade comes last. Most traders reverse that order. They decide how much they want to make, then force the numbers to fit. Professionals do the opposite. They begin with what they're willing to lose. And here's something many traders discover only after years of frustration. The purpose of small risk isn't to avoid losing. Losses are inevitable. The purpose is to make losses ordinary. Because once losses become ordinary, they stop influencing behavior. And when behavior stops being driven by fear or urgency, something subtle begins to happen. You stop needing every trade to be right. You stop chasing. You stop forcing opportunities. Instead, you start waiting patiently, confidently. Most traders believe risk begins when the market moves against them. That's what it feels like, doesn't it? You enter a trade, the price starts falling, and suddenly you feel exposed. The loss appears on the screen, emotions begin to rise, and you think that's where the danger started. But the truth is, the real risk was determined long before the market moved a single point. It was determined the moment you chose your position size. Think about two traders taking exactly the same setup. They enter at the same price. They place the same stop loss. They watch the same market. Yet one remains calm while the other becomes anxious after a small move against him. Why? The chart is identical. The setup is identical. The difference is not the trade. The difference is how much each trader decided to risk. This is one of the most misunderstood realities in trading. Traders spend countless hours searching for perfect entries, while paying little attention to the amount of capital they're exposing. But the market doesn't care how confident you are. It doesn't care how convincing the pattern looks. It doesn't care how many indicators agree. A great setup with excessive size can be dangerous. An average setup with controlled size can be manageable. The trade itself is rarely the problem. Position sizes. Have you ever noticed how traders often become most emotional on trades they are most certain about? That's because certainty creates temptation. The more convinced they become, the larger they trade. The larger they trade, the more important the outcome becomes. And the more important the outcome becomes, the less objective they become. What started as confidence slowly turns into pressure. Pressure turns into hesitation. Hesitation turns into mistakes. The chain reaction begins not because the trade was bad, but because the position was too large. This is why professional traders often think differently than beginners. Beginners ask, how much can I make? Professionals ask, how much can I lose? That single shift changes everything. When risk is defined first, position size becomes a calculation instead of an emotional decision. The trader stops trying to maximize profits and starts trying to preserve flexibility, because flexibility is what allows you to think clearly. Imagine losing 1% on a trade. It's disappointing but manageable. Now imagine losing 15%. Suddenly every decision feels urgent. You start watching every tick. You second guess your plan. You hope instead of analyze. The market hasn't changed. Your position size has, and with it, your psychology. This is why some traders can survive long losing streaks while others are destroyed by only a few losses. The difference isn't usually skill, it's exposure. A trader risking too much doesn't need many mistakes to create serious damage. A trader risking little can withstand mistakes, learn from them, and continue operating. That's an enormous advantage. After all, no strategy wins every trade. Even the best traders experience losses. The question isn't whether losses will come. The question is whether your position size allows you to survive them. Every trade carries uncertainty. There is no indicator powerful enough to remove it. No analysis deep enough to eliminate it. No experience level that makes someone immune to being wrong. The market has a way of humbling certainty. That's why position sizing is so important. It accepts uncertainty instead of fighting it. It acknowledges that being wrong is part of the business. And once you accept that reality, something interesting happens. You stop treating each trade like a life-changing opportunity. You stop assigning emotional weight to individual outcomes. You become more focused on process than prediction. That's when trading starts to feel different. Not easier, not effortless, just clearer. Because you're no longer trying to control what the market will do. You're controlling the only thing you actually can. The size of the risk you choose to carry before the trade ever begins. And once you understand that, you start seeing every setup through a different lens. One of the most frustrating experiences in trading is taking a setup that follows all the rules, only to watch it end in failure. You did the analysis. You waited for confirmation. You entered with a clear plan, and yet the trade lost money. When that happens often enough, many traders reach the same conclusion: the strategy must be broken. So they begin searching again. A new indicator, a new pattern, a new system, a new shortcut. But what if the setup was never the problem? What if good traders fail with good setups for reasons that have nothing to do with the setup itself? The market is a game of probabilities, not certainties. Even the strongest opportunities can fail. A perfect-looking breakout can reverse. A high-quality trend can suddenly stall. A textbook pattern can collapse without warning. The quality of a setup increases the odds. It does not guarantee the outcome. Yet many traders secretly expect guarantees. They don't say it out loud, but their behavior reveals it. They become frustrated after a few losses. They question their method after a losing streak. They abandon a plan that may actually have a positive edge. Why? Because they confuse a good process with a guaranteed result. Have you ever noticed how casinos operate? They don't panic when someone wins. They don't change the rules after a few losses. They understand that short-term outcomes are unpredictable. Their confidence comes from the edge, not from any single event. Trading works the same way. A trader can make money on a terrible setup. A trader can lose money on an excellent setup. The outcome alone tells you very little. What matters is whether the decision was sound. This is where many capable traders get trapped. They become obsessed with being right. And the moment being right becomes more important than following a process, problems begin. A trader enters a good setup. The market moves against him. Instead of accepting the possibility of being wrong, he widens the stop. Then he adds to the position. Then he ignores his rules completely. The original setup may have been excellent. The execution was not. The failure didn't come from the opportunity. It came from the response. This distinction matters more than most traders realize. Because over time, Success is determined less by finding opportunities and more by managing behavior around opportunities. Think about it. How many traders know what they should do? Most of them. They know they should manage risk. They know they should respect stops. They know they should avoid emotional decisions. Knowledge is rarely the issue. Execution is. The challenge is not learning the rules. The challenge is following them when money is on the line. That's where discipline separates itself from intelligence. A trader can have an exceptional understanding of markets and still fail because emotions interfere with execution. Another trader can have a simpler approach and outperform simply because he follows his rules consistently. The market rewards consistency far more than brilliance, and consistency becomes difficult when traders place too much importance on individual trades. Every time a trade becomes emotionally significant, objectivity begins to disappear, fear enters. Hope enters, ego enters. Suddenly the trader is no longer responding to the market, he's responding to his emotions. That's when good setups start producing poor results. Not because the setup stopped working, because the trader stopped working the setup. The professionals understand something that many beginners overlook. A setup is merely an opportunity, nothing more. Its job is to create favorable odds. Your job is to execute it correctly. When those roles become confused, frustration follows. When they're understood clearly, trading becomes much simpler. Not easy, just simpler. Because instead of judging yourself by whether a trade wins or loses, you begin judging yourself by whether you followed your process. And once that shift happens, you stop asking, was this a winning trade? Most traders believe their biggest problem is losing money. It isn't. Their biggest problem is needing to be right. At first, that sounds harmless. After all, who doesn't want to be right? The issue begins when being right becomes more important than making good decisions. And that happens far more often than most traders realize. Think about what happens when you enter a trade. The moment money is involved, the trade becomes personal. You stop seeing it as a probability and start seeing it as a prediction. The market is no longer simply moving, it's either proving you right or proving you wrong. That subtle shift changes everything. Have you ever noticed how difficult it can be to accept a small loss? Not because of the money itself, but because closing the trade feels like admitting defeat. The market is saying your idea didn't work, and the ego doesn't enjoy hearing that message. So instead of exiting, many traders begin negotiating with reality. They move the stop loss. They give the trade more room. They search for news that supports their position. They ignore evidence that contradicts it. Why? Because protecting the ego becomes more important than protecting capital. The hidden cost of needing to be right is that it distorts judgment. The trader is no longer analyzing what is happening. He's defending what he wants to happen. And once that process begins, objectivity starts disappearing. This is one reason why intelligent people often struggle in markets. In many areas of life, being right leads directly to success. In school, correct answers are rewarded. In business, expertise is valued. In professional careers, knowledge creates advancement. But trading operates differently. The market does not reward certainty. It rewards adaptability. A trader can be wrong many times and still make money. A trader can be right often and still lose money. That's difficult for many people to accept. The goal is not to predict every move correctly. The goal is to manage risk while participating in favorable opportunities. Yet traders constantly sabotage themselves because they are emotionally attached to being correct. Consider two traders facing the same losing position. The first trader accepts that the trade failed. He exits according to plan and preserves capital. The second trader refuses to admit he was wrong. He holds longer, increases exposure, and waits for the market to validate his opinion. Who is actually stronger? Most people would say the trader who stayed committed. In reality, strength often looks like flexibility. The willingness to change your mind is one of the most valuable skills a trader can develop. The market doesn't care about your opinion. It doesn't care how much research you did. It doesn't care how confident you felt before entering. Price moves according to forces far larger than any individual participant. The sooner a trader accepts this, the easier trading becomes. Not because losses disappear, because losses stop feeling like personal attacks. That's an important distinction. Many traders experience emotional exhaustion not from losing money, but from constantly attaching their identity to outcomes. A losing trade becomes proof that they are not skilled enough. A winning trade becomes proof that they're finally figuring it out. Their confidence rises and falls with every position. That creates instability. Professional traders think differently. They understand that a single trade reveals very little. One outcome does not define competence. One loss does not define failure. One win does not confirm mastery. The focus remains on execution, because execution can be controlled. Outcomes cannot. When you stop needing every trade to validate your intelligence, something interesting happens. You become more patient. You become more disciplined. You become less emotional. You stop forcing trades simply to prove yourself right. You stop holding losers simply to avoid being wrong. You stop treating the market like an argument that must be won. Instead, you begin treating it like a stream of opportunities that must be managed, and that shift changes the entire experience of trading. Because the moment your goal changes from being right to making sound decisions, you begin seeing losses differently. They stop becoming evidence of failure. They become information, feedback, part of the cost of doing business. Most traders enter the market focused on one question: how much can I make? It sounds reasonable. After all, profits are the reason people are attracted to trading in the first place. But that question often leads traders in the wrong direction. Because before profits matter, survival matters. And the traders who understand this early usually last much longer than those who don't. Think about it. What good is a great strategy if your account doesn't survive long enough for it to work? What value is a strong edge if one reckless decision wipes out months of progress? The market offers opportunities every week, every month, every year. But those opportunities only matter if you're still in the game. That's why survival must come before profit. Not because profits are unimportant. Because profits become impossible when survival is ignored. Many traders never realize this. They treat trading like a race. They want rapid growth. They want immediate results. They want every trade to make a meaningful difference. And because they want faster progress, they take larger risks. The logic seems simple. Bigger positions create bigger profits. What they fail to consider is that bigger positions also create bigger damage. And damage compounds far faster than most people expect. Have you ever noticed how difficult recovery becomes after a large loss? A 10% loss requires more than a 10% gain to recover. A 20% loss requires even more. A 50% loss creates an enormous obstacle. The deeper the drawdown, the harder the climb. This is why preservation matters so much. Every dollar protected today remains available for future opportunities. Every unnecessary loss reduces future flexibility. Professional traders understand this instinctively. They don't view capital as something to gamble. They view it as inventory. A store owner protects inventory because it's necessary for business. A trader should think the same way about capital. Without capital, there is no participation. Without participation, there is no opportunity. The objective isn't simply to make money. The objective is to stay positioned for the next opportunity, and the one after that. That's where many traders get trapped. They become so focused on winning today that they sacrifice tomorrow. One oversized trade, one emotional decision, one attempt to recover losses quickly, and suddenly months of disciplined work disappear. The market punishes urgency. It rewards patience. Yet patience is difficult when traders measure success only through immediate profits. Ask yourself this: would you rather double an account quickly with a high chance of failure, or steadily build an account with a high chance of survival? Most beginners are attracted to the first option. Experienced traders usually prefer the second. Why? Because experience teaches a lesson that cannot be fully understood from books. The longer you survive, the more opportunities you see. And opportunities are the true source of long-term success. A trader who survives a difficult period can benefit from future market conditions. A trader who destroys his account cannot. This is why risk management is not separate from profitability. It is the foundation of profitability. Every stop loss respected, every position sized correctly, every emotional trade avoided. These actions may seem small in isolation, but together they create longevity, and longevity creates possibility. The market is not a single event, it is an endless sequence of opportunities. The trader who understands this stops obsessing over individual outcomes. He stops viewing every trade as a make or break moment. Instead, he begins thinking in terms of preservation and participation. Because he understands that success in trading is not built through one extraordinary decision. It's built through hundreds of ordinary decisions made correctly over time. The challenge is that this mindset often feels slow. It lacks excitement. It doesn't satisfy the desire for immediate rewards. But markets have a way of teaching the same lesson repeatedly. Those who prioritize profits over survival eventually discover how fragile profits can be. Those who prioritize survival often discover that profits become a natural consequence of staying disciplined long enough for their edge to unfold. Most traders don't get into serious trouble because of a series of losses. They get into trouble because of one loss that was allowed to become far too large. That's an important distinction. A string of small losses is usually manageable. They can be recovered from. They can be analyzed. They can be accepted as part of the business. But one oversized loss has a different effect. It damages capital. It damages confidence. And often it damages judgment. Have you ever noticed how one bad trade can affect a trader for weeks? Not because of the money alone, but because of everything that follows. The trader starts questioning his strategy. He becomes hesitant. He hesitates on good opportunities because he's still thinking about the previous mistake. Or he swings to the opposite extreme and starts forcing trades in an attempt to recover quickly. Either way, the damage spreads beyond the original loss. This is why one loss should never have the power to change your life. No single trade should be important enough to create financial hardship. No single position should be large enough to create emotional instability. No single outcome should determine your future. Yet many traders unknowingly put themselves in exactly that situation. They see a setup they strongly believe in. Confidence rises. Position size increases. The trade begins to feel special, different, certain. And that's usually when risk becomes dangerous. Because certainty is often greatest right before humility arrives. The market has a way of reminding traders that no outcome is guaranteed. Even the best opportunities fail. Even the strongest trends reverse. Even the most convincing analysis can be invalidated. The market does not reward conviction alone. It rewards discipline. Think about professional businesses for a moment. A successful business doesn't bet its entire future on a single customer. It doesn't risk everything on one transaction. It survives because risk is spread across many opportunities. Trading is no different. Every trade is simply one event in a much larger series. The problem begins when traders start treating individual trades as life-changing opportunities. The emotional pressure becomes enormous. Suddenly, every price movement feels meaningful. Every pullback feels threatening. Every fluctuation feels personal. The trader is no longer operating from a position of strength. He's operating from a position of dependence. And dependence creates poor decisions. When too much is riding on one trade, objectivity disappears. Stops get moved. Rules get ignored. Plans get abandoned. The need for the trade to work becomes stronger than the commitment to execute properly. That's a dangerous place to be. Because once discipline breaks down, losses often become larger than originally planned. And large losses create another problem many traders underestimate: recovery. A significant drawdown doesn't simply require financial recovery. It requires psychological recovery. The trader must rebuild trust in himself. He must regain confidence. He must overcome fear created by the previous experience. Sometimes that process takes longer than the financial recovery itself. This is why protecting against catastrophic losses matters so much. It's not only about preserving money, it's about preserving stability. The best traders understand that consistency comes from removing extremes. They avoid extreme risk. They avoid extreme confidence. They avoid extreme emotional reactions. Instead, they focus on maintaining balance. A small loss remains a business expense. A large loss becomes a life event. And there is a massive difference between the two. Ask yourself this: if your next trade fails, how much will it matter? Will it be an inconvenience? Or will it significantly affect your account, your emotions, and your decision-making? The answer reveals whether your risk is properly controlled. Because the goal is not to eliminate losses. That isn't possible. The goal is to make sure losses remain small enough that they never gain the power to dictate your future behavior. When a trader truly embraces this idea, something changes. The focus shifts away from winning individual trades. The focus shifts toward maintaining long-term participation. Each trade becomes less important. The overall process becomes more important. And that's when the market begins to feel different. Not because uncertainty disappears. Many traders believe better decisions come from better analysis. More charts, more indicators, more market research, more information. And while analysis certainly has its place, there is another factor that often has a much greater impact on decision-making: risk. Specifically, how much risk you're carrying when a trade is open, because the amount of risk you take directly influences the quality of your thinking. Small risk creates clarity. Excessive risk creates noise. Have you ever noticed how differently you think when a position is too large? Every price movement suddenly feels significant. A minor pullback feels threatening. A normal fluctuation feels like a warning sign. You begin reacting instead of observing. The chart hasn't changed. The market hasn't changed. Your exposure has, and with it, your ability to think objectively. This is one of the most overlooked relationships in trading. Most traders focus on the technical side of the market while ignoring the psychological impact of position size. Yet position size often determines whether a trader follows a plan or abandons it. When risk is small, patience becomes easier. When risk is small, discipline becomes easier. When risk is small, mistakes become less costly. The mind has room to operate. It can process information without feeling pressured. But when risk becomes too large, emotions begin competing with logic. Fear enters the conversation. Hope enters the conversation. Urgency enters the conversation. And once emotions gain influence, decision quality starts to decline. Think about a trader who risks a small percentage of his account on a trade. If the market moves against him, he can still think clearly. He can evaluate information objectively. He can follow his stop without hesitation. The loss is disappointing, but manageable. Now imagine another trader risking a substantial portion of his account. The market moves against him by the same amount. Suddenly the experience is completely different. The financial consequences feel heavier. The emotional pressure increases. The temptation to interfere with the trade becomes stronger. The market is delivering the same information to both traders, yet each trader interprets that information differently because of the risk they're carrying. This is why risk management is not simply about protecting capital. It's about protecting judgment. Good judgment is one of the most valuable assets a trader possesses. Without it, even strong strategies become difficult to execute. Without it, emotions begin making decisions that should be made by a plan. And emotional decisions often create a chain reaction. One impulsive action leads to another. A stop gets moved. A loss gets extended. A revenge trade appears. The original mistake grows larger, not because the trader lacked knowledge, but because excessive risk compromised his thinking. Have you ever wondered why experienced traders often appear calm during volatile markets? Many people assume confidence is the reason. Sometimes it is. But often the explanation is much simpler. Their risk is controlled. Because their risk is controlled, their emotions remain manageable. Because emotions remain manageable, they can think clearly. Because they can think clearly, they make better decisions. Cause and effect. The sequence matters. Clear thinking rarely appears by accident. It is often the result of proper risk management. This is why professional traders tend to respect risk limits, even when they feel highly confident. They understand something that beginners often learn the hard way. Confidence is not protection. Discipline is. The market can invalidate even the strongest conviction. When that happens, controlled risk keeps the trader stable. Large risk creates instability, and instability leads to poor choices. The goal is not to become emotionless. That's unrealistic.